Let's get started. The basics. Investment versus swing trading versus day trading. The difference is in the time frame and the underlying reasons to participate in the market. Usually, investments are made in stocks, indexes, or funds which you strongly believe will do well over a long period of time, often years or decades. This is usually the primary growth accelerator for most people and can give good returns. But this topic is outside the scope of this course. Trading, on the other hand, is a more active pursuit, where you hold the financial asset, a stock or crypto or forex, etc., for a short period of time in order to make gains from the fluctuations in the market. Within this, you may again hold the asset for a few days, weeks, or months in swing trading, or only for a few minutes or hours in day trading. The content in this course is geared towards day or swing trading, where you do not hold your position for very long. One should keep the long-term investment portfolio entirely separate from the trading setup. Fundamental analysis versus technical analysis. There are broadly two styles of trading, depending upon the input variables you are considering, to forecast the probable direction of price movement. Some traders are ardent followers of only one approach and look at the other approach and its users with disdain. But there are also those traders who would deploy a combination of the two styles to improve their success rates. Fundamental analysis tries to identify the intrinsic value of a stock based on a number of parameters around the economy, the specific sector, and the company itself. For instance, if I am trading the Apple stock, I would consider the overall economic scenario, then also how the tech sector is working and related indexes. Then, I will go deeper into the management of the company itself, earnings, profits, cash flow, future launch announcements, assets, liabilities, and so on. Technical analysis, on the other hand, looks at the price movement and associated volume, etc. This school of thought believes that whatever intrinsic and extrinsic factors are affecting the stock price, the whole dynamics is reflected on the chart. Technical traders would use the charts to identify patterns and trends to forecast the direction of price movement. Long and short. When you buy a stock and intend to sell it at a higher price, your position is called long. You will say, "I am long on Tesla stock," or "I am long 30 shares of Tesla." When you are short, that means you expect the prices to drop. You will sell high and then buy low. You may wonder, how can you sell first without having bought? In a short position, you basically borrow the stocks from a broker and sell them. Then, when the prices are lower, you buy them back to return to the broker, and you make a profit on this downward move. This is largely for your understanding. It's good to have a basic grasp on the fundamental terms. While trading, you would not need to bother about buying versus borrowing, etc. It's just about taking a position at a price and then exiting at another price. You gain or lose depending upon whether it went in your intended direction or not. Here are some examples. Let's say you are long 100 shares. Your entry price was $30 and you exited at $31. Your net profit, in this case, is $100. On the other hand, if the price dropped to $28 and you exited, you have a net loss of $200. Similarly, on the short side, if you went short 100 shares at $30 and exited at $28, you make a net profit of $200. But if the price moves up and you exit at $31, you have a $100 loss. You may argue that, why would I exit if I am making a loss? I can wait for some time for the trade to be in my favor, or to at least get back to break even. But the problem here is that there is no bottom or top, and the market can continue to push against you, and the loss can be so large that it may either discourage you from ever participating again, or worse, take every penny from your account. Stop loss. In active trading, day trading, or swing trading, it is an absolute must to have a stop loss in place when you enter a trade. It defines the maximum loss you would undertake in that trade if it were to go against you. There are two common methods here. Option 1. You can use a percentage of your account value where you can define that I will never lose more than 1% of the account value in a single trade. Let's say you have $10,000 in your account that is set aside for trading. So, you should never risk more than 1%, that is, $100 in a trade. One is free to decide the percentage based on the risk appetite, but I would not recommend going above 2% per trade. Option 2. Other method is to use a fixed dollar amount risk per trade. This is what I personally use, as it gives me a clear number and is easier to play with. When I was consistent for at least 2 months on a simulator, I moved trading with real money. At that initial stage, I started with a risk of as low as $15 per trade. Moving from simulator to real trading is a major step, as the psychology factor starts to kick in when you are trading with real money. This is the biggest missing factor in a simulator. We will talk about this later, but the point here is that one should start with small risk amount and then gradually increase. Let's look at the chart here. Let's say I took a trade at $23.95 and my stop loss was at $23.40. I took 27 shares. So, the max I could lose was 23.95 minus 23.40 times 27, which equals $14.85. Just around my target risk per trade of $15. If the trade goes in my favor, I take profits and can move my stop loss to break even. If the stock goes against me, then I get stopped out at a level $23.40. It's so much more convenient to just have the stop loss built into your buy or sell process. For example, in some trading platforms, you define a hotkey that can accomplish a set of tasks. So, for instance, if I wish to go long on a ticker, I click on the chart to specify the stop loss and then hit a key combination that I have defined, for example, Shift B. The trading software then automatically calculates the number of shares I can buy at current price so that my risk is as per my defined risk tolerance, which can be $15 or $50 or something else. TradingView helps you do that visually and is really great for beginners. Risk to reward ratio. Extending my approach of a fixed risk in each trade. Let's say I enter a trade at $24.10 with a risk of $15 as shown here. Based on my trading strategy, I expect the price to touch $25.70 and thus giving me $45 as return. My risk to reward ratio in this case is 1:3. This is a very important concept, something that one needs to think of before one enters a trade. I would not prescribe a minimum risk-reward ratio, as it varies with the strategy that you have and its win rate. But usually, one should at least aim for a 1:2 ratio. Since most of the strategies have a low win rate, it is important to make sure that you enter a trade only when you clearly see the room to get at least 2R, if not more. If the expected return on the trade is lower than 2R, we should let that go and wait for next setup to show up. Bid and ask. The market comprises of buyers and sellers, each ready to buy or sell at a price, or wait for the price to reach the desired level. These forces of supply and demand control the price movement. The buyers want to pay as less as possible to buy the underlying security, crypto, stock, forex, or any other, and the sellers want to sell at the highest price possible. This tug results in the bid and ask price of a security. Bid price is the highest price that a buyer is willing to pay for that asset at that time. Ask price is the lowest price at which the seller is willing to part with the asset. The bid price is always lower than the ask price. The difference between these is known as the bid-ask spread. The bid and ask prices are continuously changing, and so is the bid-ask spread. Buy or sell, order types. Market order. A market order to your brokerage account is like saying buy me 20 shares of Tesla right away. So, whatever is the market price at that time, you buy at that price. It works in the same fashion for short order when you sell at the current price. Usually, you will get the price that you saw on screen or something very close, but occasionally you can witness major swings within a few microseconds. So, for instance, in the Tesla order that you gave, if there is a sudden price movement, your order may get filled at a much higher price than intended. I would strictly advise against market orders, unless absolutely needed. Limit order. Let's say Tesla is currently trading at $1,055. You can define a limit order. That would sound like buy my 20 shares of Tesla at $990. What that means is that once you submit the order, your broker will keep that request and execute your order when the price touches the intended level. In this case, it may happen that the price continues to go up and your order may not get filled that day or even for many days. Marketable limit order. In this order, you want to buy or sell immediately like a market order, but you also specify a ceiling or floor, beyond which you would not like to buy or sell. For example, continuing with Tesla ticker, let's say that it's trading at $1,055. You can set a marketable limit order to buy 20 stocks at current market price, provided that price is under $1,057. If you are shorting the stock, then you would say that sell 20 stocks of Tesla now, but not below $1,051. Retail trader versus institutional trader. You and me are retail traders. The small fish, if you would like to call it that. Hedge funds, investment banks, and other similar players are the institutional traders. They have a team of experts and usually deploy sophisticated computer algorithms to trade. A lot of books and online lessons talk about beating the market, winning against the sharks, and whatnot. Let's be realistic. We buy 10 shares, 20 shares. Institutions trade in millions of shares. With that kind of big money behind the trades, we are not even in a position to beat them, unless a lot of retail traders collude to go after the institution. Like it happened recently with GameStop. Anyways, that is not a usual occurrence and there were other forces at play. But the point is that we do not need to fight the big guys. We need to just understand where they are going and just ride along. We will explore this in further detail in later chapters. Algorithmic trading. I mentioned that the institutional traders use sophisticated algorithms to make trades. Those are proprietary algorithms owned by the institutions. But as a tool, algorithmic trading is also available to retail traders. Sophistication of the algorithm depends on the capability of the individual or a group of individuals to come up with a logic and implement it. There is a growing trend towards automated trading which eliminates the emotional quotient from trade execution. But this is outside the scope of this course. Once you master the concepts of manual trading, you would understand the challenges and benefits, and then you may decide for yourself if you wish to continue manual trading or learn algorithmic trading. If you are already a coding expert, then the learning curve may be much faster for you. But let's park this for now. Sending the order via trading platform versus actual fill via broker. For day trading, you would use a trading platform like DaStrader, Thinkorswim, TradingView, TWS, etc. This platform is used to fetch real-time market data, view charts and various technical indicators, set up trading scripts or hotkeys, enter and exit trades, and so on. You need a platform that is fast, especially with day trading, and you need real-time market data. In swing trading or longer-term investing, it's absolutely fine with some delay, but not in day trading, as you need to get in and out of a position in a matter of minutes and seconds. Your trading platform, in turn, submits the order to the broker. Usually, brokers offer their own trading platforms, but you can also connect the trading platform of your preference to your broker. Brokers are the one that actually execute your order in the market by interacting with exchanges. You submit your order on the trading system, which in turn gives it to the broker for actual execution. You got filled means that the trade went through and you were able to buy or sell. Sometimes, the broker may have to break the lot in order to be able to complete execution. For example, let's say you gave a marketable limit order to buy 300 shares of NIO at a price no higher than $19.80. The current price being shown on your trading platform is $19.70. The order is given to the broker, and it may happen that it was able to buy only 100 shares at the price $19.70, and the price went up fast to $19.75, and then it tries to take the remaining shares at that price as it's still less than $19.80. Now imagine if it was able to only get you 100 more shares before the price went up to $19.90. So, your order of 300 shares is only partially filled, that is, 200 shares. Your order may sometimes not get filled at all if your target price is not met. Another important factor for getting a fill faster is to trade in highly liquid stocks. This is indicated in the average trading volume of the stock. I only trade in stocks with average daily volume of at least 1 million shares. Types of charts. Not so long ago, traders used to read tapes that only had textual info to make a decision. The figure here shows how a tape looked like. It had information on the latest price for various tickers and the volume traded. With the advent of technology, we now have price and volume depicted in graphical charts, which makes it much easier to identify trends and make informed decisions. There are a number of charts available on any trading platform. Here are a few examples. This one is a bars chart. Here is a candles chart. And this one is a line chart. Candlesticks are the most commonly used, and going forward, all our discussions will use the candlestick charts. Key components of a chart. 1. The ticker. Ticker is the underlying financial asset being traded. The stock, crypto, forex, etc. 2. The time frame. The time frame of the chart is the unit of time that each candle represents. Swing traders watch daily, weekly, and monthly charts. Day traders usually look at daily, hourly, 30 minutes, 15 minutes, 5 minutes, and even 1-minute charts. The figure here is a daily chart. Each candle represents a day. 3. The axis. The x-axis is time. The y-axis is the price. 4. The candles. Let's discuss these in the next section. Great sculptors and artists spend countless hours perfecting their talents. They don't pick up a chisel or a brush and palette, expecting immediate perfection. They understand that they will make many errors as they learn, but they start with the basics, the key fundamentals first.